Hi, good afternoon. Turning out to be a very quiet day so far. We've been just consolidating in a very, very narrow range. Those jagged edges, don't go by that. It's been a barely 30-odd point band that the Nifty has been trading from the highs to the lows of the day. What's holding out though today, once again, that defensive tilt of the market is quite evident. You have Nestle, Titan, Divi's, Unilever. They're all stocks which are holding out in trade. L&T though is pushing ahead, much unlike how it started off the day, which was mildly soft. From there, L&T, of course, has picked up about 1% higher for L&T as we speak. Hero MotoCorp is the one which has been leading the charge, as was the case pretty much yesterday as well. A complete U-turn for Bajaj Finance, though, 2.5% lower as opposed to that 3.5% kind of uptick that the stock had yesterday. Similar is the case with Bajaj Finance as well. And some of the metal stocks are the ones which are really facing the heat today. So be it a Hindalco, JSW Steel, they're the ones which are under the weather. And also names like an Axis Bank, Indices, Infosys, HDFC, ICICI Bank, they're not really doing a whole lot, largely quiet in trade. But let me welcome on board our experts on the show and figure out what is it that they're making of the trading day so far. We've got Naresh Mirani as well as Devin Choksi joining in the show right now. Naresh, hi, afternoon. Let me start off with you first. Very, very quiet today. Is it only for a dash upwards, or do you sense some fatigue setting in at an index level?
So it's been a very slow move. So it almost seems like a fatigue move, but the trend has still been positive. So till the correction or a break below 25,000 to start with, we assume that the trend is still up. Overall, the price action is still very slow across the board, but the trend is still up. If we start seeing some contribution coming in from some of the heavyweights, we could just continue. So for now, I would let the price be a confirmation, then to look at 12 days of an uptake or 14 days of an uptake. For now, the trend is still up.
Okay, trend still up. Devin, hi, afternoon. What is it that you're feeling about the market? Is it showing any signs of a fatigue? I mean, when you look at some of the individual high HNI concentrated names and the kind of fall that they've had from their previous peak, some of them are down even 30-odd% or so. What's the feeling that you're getting about the market right now?
So overall, Aisha, good afternoon. Overall, I think the market direction is very, very clear. Anything which is available at a valuation, comfortable discounted valuation, as I call it as, I think the market is not waiting for latching onto that kind of an opportunity. So obviously, I think the important aspect here would be to buy on dips. That's very, very clear and obvious. Now, where the actions are being centered at this point of time, our understanding is that majority of the interest continues to remain in the BFSI space. Uh, till now as well, I think the larger focus is on the insurance space. And whenever I think the opportunity is available in the insurance companies, definitely I think the buying is emerging into them. At the same time, I think the selective opportunities are also there in the metal commodity space, where I think larger amount of buying interest has been generated because of the fact that the input cost is coming down, and at the same time, I think the commodity prices are relatively fetching better realization for the manufacturers. So I guess I think that's also another area where majority of the interest is lined up. Yeah, I agree that I think some part of the IT and pharma, it is slightly looking tired. Maybe I think they have had the run, which is possibly the reason for which they are currently undergoing some amount of quiet movement on the counters. But maybe when we will find opportunities, if market gives correction, when we find opportunities at lower levels, even in that space too.
Wanted to understand what your observation is when it comes to the IPO market specifically, and especially after SEBI, revealing their study, which finds about 54% of IPO shares allotted to retail shareholders were sold within a week's time. I mean, the main board IPOs that they analyzed in a good 144 public issues found that flipping was highly prevalent amongst them, and I think almost about 70% booked out within a year's time.
Yeah, and why not? I think if your market is so generous, giving such a handsome rate of return in IPO after IPO, typically those investors who are buying with the IPO and selling it out, I think they're having maximum number of rotations opportunity in the course of the year. Even assuming that out of 10, in 8 you succeed and 2 you don't. And still, I think there are class of people, including within the fund investment, that they want to play around with the IPO opportunities. So yes, I think currently the market is systematically chasing companies which are hitting the new segment, the IPO market. In my understanding, I think the flow in the entire IPO system, to an extent, I think it has been addressed, which means I think the funding of the IPO has been stopped. But still, in the individual account, I think the funding is possible. So, as a result of which, I think the traders who are applying for the IPO, they use the individual accounts for applying the funding, etc. In my viewpoint, I think the other flow in the entire IPO segment is that probably we have created too many segmentations, institution segmentation, HNI segmentation, retail segmentation. I think ultimately they need to make it fungible, and the way in which IPO should be conducted on a first come first basis on the trading screen, direct allotment. If that situation comes in, then probably I think the current level of whatever misuse, as we call it as, which is happening in the system, will probably go on.
Right. In fact, speaking of this, we caught up with some top market veterans, the likes of Mahesh Nandurkar as well as Sunil Subramaniam, to understand what they make of this and how one should really move ahead given the kind of regulatory concerns surrounding this. Let's hear out what they had to say.
We looked at some of the recent news flow in terms of a small IPO, kind of trying to raise about 11, 12 crore, getting subscription worth about 5,000 crore. So clearly, these are all signs where we are seeing, excessive exuberance in certain pockets, of the market. As you rightly mentioned, SME probably looks like one. But I think that could be applicable for some of the small cap, mid cap names in the main market, as well. So yeah, I think the regulators are warning the individual investors, around this. But I guess at this point in time, what is really working is, things are looking good. People are making money, and that's why one is leading to the other.
Post-COVID, we have had these youth who have come with a lot of time on their hands, with internet and technology at their hands, who are treating the stock market like a gambling den. I think this is all part of a healthy capital market. It's only when you have these speculative entities like these people come in that there is liquidity in the market. But if you regulate them and take them out, overall as a market, the liquidity is going to shrink. Putting any regulations, right, which gives the signal that SEBI says this is, what do you call it? Irrational exuberance, is that those kind of words could trigger a collapse. So I think we need a regulated move from this chaos, and it's not easy. I would suggest we start by first talking, advising, guiding before we introduce any harsh actions which could give a wrong signal to the market and lead to a domino effect.
Too much of SME sort of framework also, SMEs getting too much funding or their prices going up is also bad. And that's what creates apprehensions across, saying there is a runway growth there and we need to be very aware and take actions against. SEBI has also over the weekend made a statement that they are going to come out with new regulations on SME, which will be much tougher.
Maybe the diligence that is required of the chartered accountants, merchant bankers, and exchanges is possibly missing, and they need to do some hard work over there. And analogy can be drawn with a doctor. Please be good doctors to these companies. Don't give them steroids when they can survive on paracetamol. Growth is very much there. We are growing very, very fast, and we do hope that all the intermediaries help to fostering the SME system in the country.
Well, holding out quiet, at least for the benchmark index. Other than that, of course, it's a comfortable spot. There's Hero MotoCorp. Now they're looking to debut into electric three-wheeler space. So that stock, of course, has been a buzzer today. There's Gujarat Gas after their tearaway run yesterday, after them announcing that they're looking to merge their subsidiaries into the parent company. And now JP Morgan has also come out with a note maintaining their underweight, though, with the target price of 457. Today, it's a little somber after that runaway move in the stock price yesterday. JP Morgan believes that reorganization is only going to increase their exposure to commodity prices and that gas prices are expected to remain soft for now. Pharma names, of course, holding out very well. You've got a Sun Pharma, Cipla, Gland Pharma. All of these stocks are very, very smartly scaling up in trade. Gland, of course, has partnered. Market share trend was very, very encouraging for them with gains across the large products category. The July data, the official July data indicates very positive traction in the US generic sales. So that's really auguring well for some of these pharma stocks. But we've got Aditya Arora as well joining in on the show to talk about what his technical thoughts are on the market right now. Aditya, where is it that you're finding leadership on both ends? That's strength as well as weakness in the market. Any segment of stocks or particular sectors?
Very good afternoon. Look, I think there are a lot of sectors where distribution is clearly visible. For example, auto, we are already hearing that there is inventory pile up. And even if you look at the international markets, then auto majors are trading at 52-week low. And in Indian market also, since last few days, there's sluggishness in top auto companies. Every good news is also being sold into. We have seen a lot of good news in this sector, but that got sold into, and there's no robust price action over there. So that is one pocket. Second pocket is capital goods. Again, in capital goods, you're seeing the same kind of price action wherein, there's hardly any movement. And if there's any up move, and that is getting sold into. And we have seen about 5 to 20% correction in these counters in capital goods space. And even in auto, we have seen about 5 to 15% correction in auto counters. And third one is defense, which everyone on the street knows that it's pretty overvalued. It's consensus view that it's overvalued, but still there's sluggish action over there, and I think there's more space for downside. So clearly these three space investors can get very good price somewhere down the line. I think good correction is possible in these three pockets. And the sector which I like is FMCG. We have seen good leadership from ITC since last few days, where market is lacking proper direction and proper leadership. ITC is continuously inching up. And even when market was declining, that was holding on. So I like ITC from FMCG basket. And I think there's scope for outperformance in FMCG sector.
Okay, fair enough. I wanted to also get in your take then on what the outlook is on some of these defense counters. By the way, just pull up some of those stocks as well. And let's quickly check in on how they're trending in trade today. Do remember they have got the government approval for the 26,000 crore rupee aero engine deal. And this is perhaps a push in the direction for Make in India that the government has very well closely been looking at. So the likes of a Mazgaon Dock, a Cochin Shipyard, Garden Reach Shipbuilders, L&T, etc., all expected to gain on the back of this. Aditya, curious to understand how you're looking at this on the charts, and then Deven, I'll get in a take from you on the fundamentals as well.
True. So in Mazgaon Dock, we have seen a stellar rally. The kind of returns it has delivered it's phenomenal. But somewhere the stock will take some time to consolidate the gains. From lows of 2023, Mazgaon has gone from 350 odd levels to 6,000. So I think this is the right time where scope for outperformance is very unlikely, and stock will soon mean revert. We have already seen correction from 6,000 odd levels to 4,600. There could be short-term bounce in the counter, But in medium term, I see this counter inching towards its important moving average, which is placed around 3,700, 3,800. So that eventually turns out to be a time-wise correction and price-wise correction in Masgao Dock. And second one is Cochin Shipyard. Similar kind of price action we have seen in this counter stock ran away from 250 odd levels to 2,800. And from there, we have seen a lot of distribution at the higher levels and significant price action, good volumes. So that suggests that a lot of smart hands distributed the counter at the higher levels. So I don't see scope for outperformance in this counter for pretty decent time. So I think big money wouldn't be made in these defense counters. One should wait for lower levels. Probably there the risk reward would be better.
Okay, now let's get in the fundamental take. Deven, your view on defense stocks and what this news potentially means?
Yeah, well, I guess I think the price correction has happened, but still the valuation rationalization has not happened. On one side, I think it's even if we assume that I think 20-30% kind of a price correction has happened, still both these companies are quoting between 40 to 60 times price earning ratio on a trailing 12-month basis. Even if I take factor into account 15 to 20% kind of a growth 1 year forward, still I guess I think the valuation is not quite decent. I guess I think it is expensive even at this point of time unless you see the larger amount of execution happening and generating better amount of profit and the growth in the profit, I don't think that I think immediately the valuation is going to get corrected. Uh, to me, I think more or less I understand that I think it is going to be a time correction more than the price correction now, at least for the time being. So one will have to wait and see how exactly it pans out. But yes, I think it would be I think good amount of the time correction that we'll have to see in this context.
Okay, fair enough. That's the view coming in on that entire cluster of stocks in trade. Meantime, what have been your key takeaways, Deven, from the auto sales numbers that have come in? Because at best, it's been in line with what the street was expecting. No real fireworks here. So what's the outlook on auto?
Remains, I think, positive. I agree that I think in this quarter, which is generally the case also, that ahead of festival season, couple of months are soft months, and at this point of time, even the inventory is higher. So good time for the buyers. According to me, I think if the higher amount of inventory and the larger amount of discount is made available to the buyer, it's going to be a good time. And this may be, I think, a temporary phenomena at the same time, because overall the demand scenario is not getting affected. On the contrary, disposable income in the hands of people increasing. And if the rate of interest starts coming down, then possibility of, I think, you seeing the pickup in the demand eventually could be on a higher side. So maybe I think 1 or 2 quarters of slow uptick in the auto space for the time being. Maybe by the end of the third quarter or fourth quarter beginning, you should be seeing a reasonably steady to better outlook coming in for, particularly for passenger vehicles. I think the commercial vehicles and the two-wheelers, they are relatively different. Two-wheeler demand scenario continues to remain upbeat. New generation of vehicles, including the flex fuel, which is now being in demand, particularly in the CNG side of Bajaj motorcycles, and electric vehicles, I think scooters, they are all basically driving the new level of growth for two-wheelers. And commercial vehicles, I think we remain distinctly bullish about because of the prospects involved in higher amount of expenditure happening in the economy and infrastructure side and also by the industry. So the commercial vehicle two-wheelers, I think we remain relatively more sure. Passenger vehicles, maybe you should be seeing the recovery from the fourth quarter onwards.
Quite interesting. Naresh, where is it that you're seeing fatigue or, still further strength on the auto charts across the board?
So in auto, we've started seeing fatigue in a lot of names. But after a pause, so for example, if you look at Bajaj Auto, it took a pause for the last few months and then again started. So the longer term trend is still up for most of the names. So Tata Motors is showing a lot of fatigue around that 1100, 1150 mark, has not been able to cross in a major way. TVS Motors, for example, did make a new high, but did not see a large momentum as such. On the other hand, Eicher Motors is one which looks promising out of the whole auto pack. It has been testing that 5,000, 5,050 mark. So that could be the new one in the auto pack, which could do better. And that could take the lead. Hero MotoCorp also went through a phase of consolidation for the last couple of months. Has seen volumes in the last 3 days. But out of all the names, there is a pause in majority. But Eicher Motors is the one which could break out.
Okay, let's take some closing strategies as well then on that note. Naresh, you only go first.
So that would be a buy on SBI Cards, which after a long time consolidation for a long period of time today has given a breakout, has been seeing volatility. So closer to this 760 odd mark is a good entry point for the stock, which could go towards 800 in the short term.
Right. Okay, let's take a very quick break then on that note. Devin, we'll let you go on that note. Thanks as always for joining in and chatting with us. Quick break. When we come back, the last half an hour of today's trade.
Welcome back. Still tuned into Closing Trades. Let's also bring on board then our next guest who is joining in. And we've got Ajay Bhatt with us. Ajay, good afternoon. Let's get in a take as to how you're looking at the entire IT space first up, given the fact that we have seen that outperformance sort of continuing into this month. What do you expect the rest half of the year is likely to, or the remainder of the year rather, is likely to bring for the IT space?
Yeah, IT is looking good. There is continued buying in IT that we are seeing, and we expect better results coming in from IT. The AI part, which was, the cause for worry, and we have seen the employee headcount going down as well. What we are seeing is a number of end users coming in. So as I had explained earlier, the semiconductor companies, as the enablers were doing very well, as the suppliers of the AI chain were doing very well. And the end user companies were looking at end use cases, and in the center were our IT companies. Now we are seeing, if you see this quarter's management commentaries, 200, 300 caselets, 200 end use being talked about. I think that's coming through quite well. And so IT remains a top sector, is what I would say.
Just today we spoke with Chintan Thakkar as well from InfoEdge to try and understand whether or not IT is in for a meaningful recovery or not.
If you look at last 6 months' time, and even if I look at the 4 quarters before that, it looks like that it's a kind of a U-curve type of recovery. So we have kind of gone a little bit down, particularly on the IT hiring side. We have for a few quarters remained flattish, and there are some green shoots now on the IT side. Non-IT in any case seems to be growing. So that's a positive outlook. So we are hoping that it's a U-shaped recovery, and we have tried from here it will go upwards. So hopefully this should result in the months to come, and there will be some fresher hiring as well, because the utilization rates have peaked, and people and the IT services company really do not have benches available to them. So maybe that would be a positive news for the freshers.
Okay, fair enough. That's the view coming in on the entire IT basket. Meantime, Naresh, let's get in some chart checks going. Johnson Controls, 10% higher, and there's also a Bombay Burma that's active in trade.
So Johnson Control has been in a uptrend. It gapped up from the 1250 mark, went up to 2200 real fast, and did a little bit of a correction. Now again, 2200, 2250 would be a stiff resistance for the near term. So for now, given the spike of more than 10% in a day, would wait for a fade off going forward, but the trend is still positive. Bombay Burma, one needs to be looking at a profit booking zone going forward. It remains a holding company. The stock has gone from 1500, 1600 in June all the way to now 2600. So overall, if somebody continues to own a stop loss at 2500 would be fine, but at current levels, a fresh buy does not warrant a risk reward.
Okay, fair enough. That's the view coming in on some of those smaller stocks. In the meantime, how do you stand, Ajay, when it comes to the entire defense space? We were talking about a big shot in the arm having come in for the sector. A lot of these stocks as well are abuzz in trade, largely on the back of that nod for the aero engine deal. Where within defense do you find comfort?
Yeah, Avan, the issue in defense, if you recall, 3 months leading into the budget, we saw very sharp run-ups, and we were saying that the valuations are now factoring in multiple years of execution, and we saw a brief sell-off. I still think that defense holds a lot of potential. Valuation was the big issue. So now news flow driven moves we are seeing, as with this 26,000 crore order for aero engines and stuff. So a lot of it is now dependent on the order books or the new orders coming in. What is a given is very well run companies, mostly in the government sector. It is a sector which will continue to see a lot of investments as the defense gets modernized, and given the kind of challenges India faces with China and Pakistan on the borders. So the order books will continue to shine. Companies are very well run. They have good margins. What was an issue was the valuations. Are we out of the woods there? I don't think so. But you will get moves like this. We saw, three sectoral funds also being launched on the defense side. All gave negative returns over the last 2 months, as the kind of correction that we saw. We're not out of that valuation, overvaluation zone. I would still say we can hold on, and no fresh investments either in defense or railways. Both were sectors which really got bid up going into the budget. We can wait some more time. Most of the good news is factored in. So you will see these kind of moves on the shipbuilders or on the defense contractors, but the valuations remain quite high, and the scope is more for corrections rather than going up further in the near term. I would say next 3 months, 6 months can be a wait and watch period for these stocks.
All right, wait and watch. And in fact, speaking of these stocks all rallying in trade, that's largely on the back of that anticipated outcome from the DSE meeting that's underway. Let's find out what exactly is on the agenda and the projects that are likely to receive a clearance. Our sources are picking up all of those details. Let's take it across to Prakash Priyadarshi to understand more. Prakash?
Yes, we are learning from our sources that the Defence Acquisition Council is likely to take some big decision today. The meeting is being chaired by the Defence Minister, which is underway, and we are given to understand that the defence projects worth rupees 1.4 lakh crore are likely to be cleared by DSE. If you look at the details of the agenda, sources are informing that DSE may clear acquisition of 26 Rafale maritime strike aircraft that will enhance the capabilities of Indian defence forces. Along with that, the decision likely on construction of 7 new warships with the cost of rupees 70,000 crore, which is part of the agenda. And companies like MGL, GR, SAR, prime contenders for building advanced warships. In addition to that, we are also given to understand that the DSE may approve the Indian Army's project to induct 1,700 new tanks that will replace Russian origin 272 battle tanks with the cost of rupees 50,000 crore. So these are the important agenda for DSE. For its consideration, we are expecting some big decision today.
Okay, some big decisions anticipated today. But Ajay, in the meantime, just wanted to understand your own sense on where is it that you see banks headed now? There's been that stark underperformance vis-a-vis the rest of the market. Credit growth clearly seems to be flagged off by one and all. Do you think banks can really play catch up, or do you think the underperformance and the gap within the rest of the market is going to remain?
Spot on. Banking has been an underperformer on a relative basis, and you have other options, and especially, I would say, Aisha, the bigger trend for the rest of the year is the rural economy coming back. The two-wheeler numbers have shown an uptick. That's a good pointer. Tractors are flattish to positive. I think the rural economy coming back is a bigger story. Banks, the issue is twofold. One is there is going to be a NIM compression given that there is a deposit war out there, and that sustainable funding is still being sought. There is no tax concession that the bankers were really looking at. And if you look at the amount of money that's going into the stock market, so from the affluent and the mass affluent classes, a big chunk of the financial savings are going into the markets through various instruments, be it mutual fund, insurance, the provident funds, NPS, or direct investments. And we are seeing bank deposits hurting. They have to increase rates, and that is causing a NIM compression. Second, in terms of where we are in the cycle, normally with the rate cut, again you see a compression of margins for banks, and that then is not a good forward-looking indicator for the performance of banks for the next 6 months. We are expecting rate cuts to start in India by December, and going into that, you could see continued underperformance from the banking sector. Other financials like insurance or mutual funds, even the brokerages have different drivers. That's a financialization driver. For banks, it's more disintermediation that's happening. Money is going into other avenues rather than sticking to bank deposits, and that's causing a margin compression along with the overall credit being overall credit slowing down. That is contributing to weaker bank numbers, and that's the perspective for the next 6 months. But on a long-term basis, of course, they are the suppliers to a growing economy. They will do well. But I think next 6 months you can find much better returns in, say, power financiers or insurance or mutual fund companies. Those will probably do much better than pure banking plays.
Okay. Meantime, wanted to get in your take, Ajay, as to what the reading has been on some of these recent listings. Has anything, particularly stood out? We also had a very recent Ola Electric IPO. How have you looked at some of these stocks?
Yeah, it's a function, one of a good amount of liquidity really chasing, returns, and especially on the SME segment types, we have seen a huge amount of liquidity really leading to massive listing gains and fundamentals becoming upended. So I think we are more towards probably the third part of the market, the third quadrant. It is we have gone past the mid cycle and probably going towards the late cycle, seeing the kind of valuations and the kind of frenzy there is to invest in new listings. When you have most of these companies have comparable peers available in the secondary market, but it's the listing gain. And because of the ASPA, what is your minimum return is your savings account return, and your maximum is your listing gain. And yesterday's SEBI report has shown the same, where 50% plus investors are jettisoning their listings within a week, and say 70% within a very short period of time. So it's more a gamification of investment that's happening through IPOs. In terms of companies, new age companies are welcome. They broaden the market. That is true. But the failure rates are also there in them. The good news is that most of those who make it to the IPO will hopefully create sustained value for investors. The issue only is that the smart money is getting out. So, more than 1 lakh crore of PE money has gone out, more than 1 lakh crore of promoter selling has already happened. those two are not very good indicators for the markets. They are actually contrary indicators. You can say, okay, the funds might have matured, or you have to see it as pots of money and not as full pool in terms of the private equity part. However, that might be. There are cases where a new fund within the same family takes over an investment. When they are selling out and booking out profits, and the retailers are coming in and picking up that paper, it's not a very good predictor of future market returns. So I would say that's a word of caution with promoters selling and the institutional investors selling out through these IPOs. But a lot of froth, a lot of overvaluation, and a lot of FOMO are driving retail money into these IPOs, which normally doesn't end very well. Very difficult to say where you are in the cycle, but probably now we are at least in the second half, if not in the third part of the quadrant.
Okay, fair enough. That's the view coming in on some of those recent IPOs. And Ajay, what's the take when it comes to cement? So much consolidation that we've seen take place within the sector. A lot of the larger players galvanizing the smaller ones. What does this spell out for some of the smaller cement counters?
Yeah, attractive takeover options, and the market is punting on that. But overall, if you look at it, too much capacity already in and being brought on, again brought in. Yes, we have a massive infrastructure creation going out in the country. Second, rural demand picking up is a very good predictor. Normally, cement offtake is huge even in the rural sector. So be it the Pradhan Mantri Awas Yojana or the Gram Sadak Yojana, or even rural housing, rural private housing coming up. Those are good predictors of cement normally. The issue is twofold. One is the overall volume growth is not that great. Second, too much of capacity has come in too fast, and still more plants are being talked about. Too much expansion of capacity has happened. That has taken away the pricing power just when raw material costs have been going up. So unless there is some rejig in the model, and hopefully, we get to a situation of an oligopoly where a few big players control the supply, which is what is happening with the smaller players being taken over. That will lead to some amount of pricing coming back. I remember 30 years back, or say 35 years back, my professor was doing a thesis, and I had done, work with him on cartelization in the cement sector. So, it's not something new. It used to happen, but now the pricing paradigm broke up because of the massive amount of, capacities that came in. But now a few big players are gobbling up share. So I think it will become a 3 to 4 way market, and that will bring back pricing again, but not in a rush. Overall, good, very steady eddy kind of a sector, but not the right point to invest. I think you will have better options in other manufacturing names, or financiers of that manufacturing might be better off than cement players per se.
Talking about cement, JK Cement came out with their, Investor Day presentation. Let me take it across to Ashesha and understand the key takeaways from there.
Well, yes, JK Cement has laid out aggressive expansion plans over the next couple of years. As far as their clinker capacity is concerned, it currently stands at 14.5 MTPA, and they are looking to expand it by another 3.3 MTPA by FY26. As far as grey cement capacity is concerned, their current capacity, which currently stands at about 24.3 MTPA, and they are looking to expand it to 30 MTPA by FY26. In fact, they also say that beyond FY26, they have adequate with limestone reserves and land bank in order to expand their capacity beyond FY26, and they've given a plan of about 50 MTPA cement capacity by FY30, implying nearly 13% CAGR over the next 7 years. Moving on to their paints business, which currently generates revenue of about 150 odd crores, they are looking to inch it up to about 250 to 300 crores by FY25. And remember, most of these cement companies have aggressive cost saving plans as well, and JK Cement has also said that they are looking to achieve cost savings of about 150 to 200 rupees per MT over the coming years. So yes, aggressive capacity expansion plans, cost saving plans as well. Important commentary that is coming from the management.
All right, thanks very much for giving us that heads up. In the meantime, Naresh, let's get in your take then as to what the outlook is on some of these cement counters in trade.
So out of these names, JK Cement is the one which is broken out today. After almost consolidating for 6 months, 6 to 7 months, 4,600 was a resistance tested 4 or 5 times today. That's the stock which has broken out. Ultratech continues to be in a trending up longer term basis, but on the short term continues to be sideways. Out of all the names, one is JK Cement, which looks interesting, and maybe a Dalmia Bharat if it starts sustaining above the 1950 mark. That's made a triple bottom around 1700 and is trying to reverse. So I would go with the smaller names like Dalmia and JK.
Right. Aditya, any stock strategies that you may have? Any BTST trades that you're spotting?
Actually, there's very less momentum in the market right now, but as we were talking about JK Cement, even I like the patterns of JK Cement, so that could be one of the carry forward trades. One can buy this at 4560 and 40 should be the stop loss, and target should be 4670 to 4700. And one more counter which is showing traction and saw good movement in the last hour is PFC. That looks good at 563.35. This could be bought at current market price, and stop loss should be 542 and target should be 575.
And Naresh, let's get in yours.
So the two names would be would be a buy on SBI cards, a revised stop loss at 760, target price of 775. Second would be a buy on JK Cement, which has broken out, a stop loss now revised to 4620, target at 4700.
All right, there you have it. Those are some of those BTST trades coming in. Just checking in on what the market is up to. And it's lackluster at best. If anything, a little bit of traction being witnessed within the broader universe. But metals continue to remain a big drag. Ditto when it comes to the PSU basket. How have you looked at everything that has taken place, Ajay, when it comes to Z Entertainment? And what's the update on how investors should be approaching the stock? Is it with caution?
Aman, overall, I can't talk on a particular stock, but media as a sector is well positioned. The problem has been the size of the sector, so it remains small. So I would say that overall, if you're seeing India as a huge consumption economy, the media and all the other plays along with it, be it the OTT, be it broadcasting, be it direct to home, all other related sectors which comprise the media sector are very attractive. The issue has been that though a big money has entered a few of the companies, but we have not seen that kind of scale yet coming in. So governance and scale, I think these are the two big things. If we get that right, we will see at least a few companies becoming global companies via Indian media. But I think we are some time away from that. Particular stock I would not like to comment on.
Just looking at some of the other stocks which are, moving up right now in trade. And, we've been talking about as to how there is an uptick on Hero MotoCorp. They're definitely looking at launching perhaps an EV three-wheeler. That is what the buzz is on the street. And then, of course, you've got a Nestle, Titan. Some of these urban or premium consumption trends are getting back right now in the market. And, of course, pharma continues to remain a steady place. Sun Pharma, Cipla, Divi's, they're all holding out quite okay as we speak right now. Wanted to get your sense, Ajay, on what you're thinking about FMCG right now. And within FMCG, are you looking or recommending at increasing exposure to the rural plays as opposed to urban?
Yeah, spot on. I would say rural plays. The last 1.5 years in FMCG was premiumization story as the rural sluggishness was there. The rural demand is picking up. The cycle is turning more towards rural consumption, which is more mass market kind of stuff. So expect staples to do very well, the FMCG players to do very well. And Aisha, normally what we see is that the jewelry companies as well as the gold loan companies also tend to do well as the rural demand pickup comes in, which is a bit of counter intuitive stuff, especially on the gold loan companies. But they seem to have a very strong correlation with the rural demand. So two-wheelers, tractors, FMCG, even durables, I think are going to have a very good next 6 to 12 months on the back of a reviving rural demand, and that will pick up. Urban demand is more sluggish. We are seeing an issue with entry-level jobs. You are seeing all colleges today. We had IIT Bombay putting out a number that 75% students got placed, and the lowest placement was at 4 lakhs per annum. That is a predictor that you are seeing, and other leading indicators are showing a weaker urban demand, but rural demand is picking up.
Okay, uptick in rural demand. Ajay, we'll let you go on that note. But Aditya, just wanted to get in, some strategies when it comes to pharma and FMCG, if you would have any.
I was discussing that I like ITC. It has given a good breakout in last few days, and mostly the stock has been range bound, but it's trading with positive bias. So we can have level based approach in ITC. Currently, the stock trades at 510. Again, momentum would return in the counter above 518. So that would be a buy at 518, and stop loss would be 505, and target should be 535 to 545. And in pharma space, I like Sun Pharma. Sun Pharma is trading with positive bias. Again, these stocks are pretty range bound, but they're outperforming in the market. Wherein, even in days where markets are down quite a bit, these stocks are, holding on strongly. So I think these are like consistently climbing up. That kind of stock, I don't expect, a spurt, a breakout kind of a spurt, but one can hold on to these two counters. If we discuss about levels of Sun Pharma, then it's a buy at 1843. Stop loss should be 1800, and target would be 1890 to 1930.
Let's wrap up the markets then, and a pretty flattish day of trade, and that seems to be the trend that we've been seeing day after day for the equity markets as we wind down around the 25,270 mark. It's a bit of red on the screen for the Sensex with a mild negative bias, and you have media to blame for that, energy, metals, not to mention PSU banks and even the real estate basket. Banks, though, amidst all of what we've seen today, have managed to be the lone soldiers in the green. Added to that, you've got a little traction coming in from pharma. By the way, the broader end of the market has managed to see a little outperformance as compared to the frontliners. Let's take it straight then to some of the Nifty drags in today's trading session. Then Bajaj Finance on top of that list. HCL Technologies feeling the heat within the IT basket. ONGC, Adani Ports, Eicher Motors, Bajaj Auto, and that entire cluster of auto stocks is under pressure. Reliance Industries goes home with a cut of 0.5%. SBI Life in the green. Some stocks like Titan, HDFC Bank, ICICI Bank, Axis Bank, SBI, they have managed to keep the markets afloat. Within the newsmakers, then in today's trading day, defense stocks, of course, up and about in trade today on the Aero Engine deal, 26,000 crore rupees. You've also got a GMR PA. BNK Securities has a buy with a 184 target price there. Brigade Enterprises, a 1500 crore rupee QIP. NMDC, the iron ore production is down nearly 10%. Hero MotoCorp, meantime, ET reports indicate that they are in advanced talks to invest in Altigreen and foray into the E3-wheeler segments. Adani Wilmar has issued a clarification saying that they are evaluating strategic options, so not anything conclusive when it comes to acquisition of FMCG brands. Z Entertainment, a big drag in trade. Pfizer, Torrent Power, Spark, Serra Sanitary, Phoenix Mills, something like a Jindal Stainless, Godfrey Phillips, JSPL, all are under pressure in trade today. Godrej Industries a solid 20%, GM Financial, Quest Corp, Prism, Raymond, Oracle Financial, Bajaj Consumer, as well as Aegis Logistics and Venky's go home in the green. On that note then, we'll wind it down on this leg of the show. Thank you so much to our guests for joining in. We'll wrap it up. Thanks.